So today we'll discuss a topic that could make a big difference in your retirement planning, and that is how to combine your pensions and ISAs for the UK retirement. So if you're trying to figure out that how I could get the best of both worlds, and that is tax efficient savings on the one side as well as the flexibility side of it, then this video is for you. So please make sure you stick around right to the end, because I'll share a simple 3-step framework to bring it all together. So today we'll discuss pension versus ISAs, get the balance right, how to combine pensions plus ISAs for the UK retirement, and this 3-step framework. Now, the first very obvious question which comes in our mind, and that is why to combine them together? Why not just pension or just ISA? So in the UK, we have two powerful tax efficient savings account, and that is your pension and your ISA, which is also known as individual savings account. And that is mostly for the employees. So wide majority of us will be using these two tools so that we can advance and we can have a very good retirement pot. So let's discuss the pros and cons of each of these tools first. So there are three key points which we need to understand, and that is, the first point is you get the tax relief at source in your pension contribution, and that means that it's a fancy term of saying that you get the government bonus. So just in case if you're putting £80 each month, you get £20 bonus right from the government, and that is a tax efficient saving. So your money will grow automatically. On top of that, you get your CAGR, your return, as well as you get some other bonuses. Now the second point is the pension is grow totally free from any type of taxes such as American withholding dividend tax, or any type of dividend tax and capital gain taxes and things like that. So this is completely free. There is a catch though, that you cannot withdraw your money before 55, and now it's going to become 57 from 2028 onwards. So you won't be able to withdraw that, and there is a tax implication just in case if you withdraw that. Also, even after that as well, there is some personal allowance which government gives to each and every individual. So you need to make sure that you should not withdraw, or just if you're trying to withdraw more than that, then that should we should take into consideration that as well. Okay, so these are the three key points for pensions. Now let's understand the three key points of individual savings accounts, also known as ISAs. So in the ISA, these type of accounts, you won't get any government tax relief at source, such as which we have seen in pension pots. So these type of accounts won't give that sort of government benefit. But yes, again, whatever the growth you get is completely tax free, as well as dividend tax. There is no dividend tax you need to pay here, so that's also a very big plus. And the second key point is it's a flexibility, so you can withdraw at any time, just in case if you have accumulated a very good pot and if you want to withdraw all of a sudden, you can do that, and there is no tax implication on that. The third key point is, just in case if you put in £500 each month, and down the line if you accumulate that up to, let's say for example, £250,000, and if you would withdraw all of a sudden, then still again there is no capital gain taxes as well. So that's a big plus, and this is as per today. So I'm not sure what's going to happen in the next budget, which is going to roll out next month, and I'm going to update all of my videos as well. So this is just like whatever the information, whatever the rules we have currently, based on that I'm like, just preparing this. So when we look at the second point, and that is the flexibility, you get it. So just in case during the retirement or during the first few years, also known as go-go years, if you would want to withdraw some money from your individual savings account, you can do so. So you can use that money during those initial years of the retirement, and that is another kind of like a hint which I'm going to give you, and I'm going to discuss in the later part of this video, and that is going to be 3-step framework, how you can make the whole how you can get the benefit of all of them. So the logic behind having both of them, and that is, on the one side you can have like government tax relief at source, and that is 20%, maybe 25% as well, like if you're on higher rate taxpayer, and more than that as well. So it's depend on your tax structure, and this is only applicable to those who are employees, to be honest. Okay, so that is the money you get it free from the government, and also your pot will grow as well, and you get the benefit of the compounding interest as well on top of that, as well as on the another side, which is an ISA, you can get the flexibility. So just in case if you want to withdraw money, and if you have gained a good amount of like capital, so there is no capital gain tax. In fact, there is no short-term capital gain tax or long-term capital gain tax. Just in case if you do invest in India, then like up to 2 years you cannot withdraw. So there is a cap limit as well. So nothing as such in the UK case. So that's why like ISA in the UK is very, very good, and I recommend each and every individual to have at least ISA. So before combining them together and see the benefit in the long term, let's understand what are the pitfalls, and we need to learn that first, and then like we can make our own strategy according to that. So when we talk about the tax reliefs, so in the case of pension, you cannot put in more than £60,000, and that is upper ceiling limit, or your 100% of your salary, whichever is lower. Okay, so then and then only you can get the government benefits. Just in case if you go beyond that limit, then you won't get any government benefits. So that's a catch there. Okay, so we need to make sure that like whatever money we are putting in should not be more than £60,000 a year. So that is your upper limit. So for ISAs, as per this 2025-2026 tax year, the limit is £20,000. So you cannot put in more than £20,000. There are some discussions that that's going to change from 2027 onwards, and that is not, we can comment on anything about it, but yes, the limit is £20,000. So you get £20,000 a separate limit, you get £60,000 limit, so in total you have £80,000 limit. Another ISA which is separate to your main ISA pot, and that is known as junior ISA. So you get £9,000 a separate limit as well. So that's a totally separate limit, guys. So still you get a lot of advantage, and these money can grow tax efficiently, completely free from any type of taxes. So we need to remember, when we combine together, pension gives us a tax relief at source, but ISA don't. Again, when we talk about the access and withdrawals, the pension you can access only once you hit that age 57 from 2028 onwards. So if you are if you want to withdraw before 57, then there are rules. In certain cases, yes, government will allow you to withdraw your pension pot in like severe cases, like any type of any sicknesses or things like that. And if you need money urgently, yes, government and pension companies like are lenient about that. But you need to make sure that there is a cap limit, so you cannot withdraw even after 57. You cannot withdraw more than 25% of your actual pot. So if you're planning to withdraw more than that, then there will be tax implication as well, so which we need to make sure. But not in case of ISA, because in ISA the money which you are putting into that ISA pot has already been taxed. So it is our own money, and that is completely tax free, which will grow completely tax free. We can withdraw whenever we want, and that's the flexibility of individual savings accounts. Again, we need to understand that you cannot move your money from pension pot to ISA directly, or from ISA to the pension pot without following the rules, because there are some rules there. And to be honest with you, it's not a right move, because like we will be doing some calculation on our investment growth as well as the timing of withdrawals, when we are going to withdraw, at what time we need money and things like that. So that sort of forward planning needs a lot of work as well beforehand. So that's why it's not an ideal move to have switching those two accounts. So you can grow completely tax free on one side. So let it put in each month whatever you want to put in into your pension account, and this ISA should be separately to the pension account. And that's the best beauty of using those two together. Now this is the point, that how we should combine them and how we can use by using the 3-step framework. So the step number 1 is maximize your pension tax relief first. We should always focus on getting the full value of our pension tax relief first, wherever it's possible, whether you're a basic rate taxpayer or a high rate taxpayer. This is completely unbeatable. So you need to contribute enough to get these advantage first. And I'm going to share a very classic example, and that will give you the full picture how you can get it and how you can get the benefit out of it. So let's crunch the numbers. Just in case if you're investing £100 a month, and that is net amount, either straight into your stocks and shares ISA or into your pension. Okay, so in your stocks and shares ISA, it doesn't grow, but in your pension pot, it grows £125 gross for the basic rate taxpayer. Okay, when we assume a steady 8% annual return, okay, and it is compounded monthly for over 10 years. So now let's look at. So your ISA grows at about £18,295, okay, which is completely tax free. You can withdraw wherever you want. Now, when we talk about the pension, that money comes to 22,868. So basically, you're getting 25% tax free, and that is amounting to 5,717 completely tax free. Okay, that's a free money. That's all yours. So the remaining 17,151 is taxable. But when we conservatively assume that this is a tax at the basic rate tax, which is 20% on the withdrawal, okay, if your personal allowance is already used up, then this is roughly £3,430 in tax, leaving you with just 19,438 tax free plus net taxable income. So this is again much better compared to ISA. So in a way, your pension is netting more than 6.25% more compared to ISA, which is £1,143 extra, even after paying tax on your way out. So that's why the pension wins over ISA. And this is basically a conservative figure. But just in case if you withdraw before your state pension age, and if you keep your personal allowance completely free, then it's even better because you get the employer's contribution as well. That is, we've totally forgotten money, and that is basically compounding behind the scene, okay, in the background, and that can boost additional savings as well, which ISA cannot match. Now, step number two, and that is top up your ISAs for flexibility. So now once you have contributed enough to your pension pot, you can start utilizing your ISAs now to add savings you can access earlier. So just in case if you are planning to retire earlier than initial earlier years or just before your pension age, you can use this money and you can smooth your savings plan as well. So this is a very good technique. For example, if you use your ISAs initially and later if you want to switch to your pensions, then you can do that switch, and this kind of bridge also gives a very good flexibility. The step number three is plan your drawdowns and tax efficient withdrawal strategy. So as you approach retirement age, you need to think that which pot you'll access first, okay, and what will be the tax implications on those pots, as well as how much you'll take from each pots. Okay, so I can give you some ideas and that could help. So the first one would be you can draw initially from the ISA, okay, your ISA pot, and by doing so you can keep your income low and you are basically avoiding pushing yourself into those higher income tax brackets, so you won't pay higher taxes, because remember you need to pay taxes and they'll consider your final tax years as well. So that sort of tax implications, if you want to avoid that, you can do so. The second step is some people think that I want to keep my pension pot grown naturally and organically so that I can use it for my future inheritance tax purposes, so that could be the objective, then that you can use it. Again, like the third idea could be you can withdraw 25% of your lump sum amount, which is a tax free. Okay, so above 57 years you can withdraw 25% of the lump sum, okay, each tax year, and that you can use it very wisely. So there are some plans that how much I should withdraw and things like that. And also you can plan for the upcoming changes, such as estate planning, just in case, and your any type of properties and things like that. So these are the 4-5 points which you need to consider before in retirement age. Now I'll discuss a very classic example, okay, and in this example how you can balance both pensions as well as ISAs for the long-term retirement planning. Now we'll discuss a very good example here. A lady called Sarah, her age is 40 years age, okay, and she is earning around £60,000 each year. She is contributing into a pension spot as well as she is contributing into ISA, and she wants to retire at the age of 60, but Perhaps she wants to change her plan and how she can plan it out so that she can retire early, like, within 10 years time. So that's how, like, I have framed these examples. So here what actually she does, so she basically tries her level best to contribute enough to her pension pot so that she could get the benefit of employers contribution as well as the tax relief at source from the government. Okay, and because she is a higher taxpayer, she'll be getting some more than that. Okay, so that she could claim back as well from her self-assessment return form. Okay, so this is the first step she does. The second step she does is she makes sure to put in enough, as much as she could, into her stocks and shares ISA. So the annual limit is £20,000. I'm not saying that she is hitting that limit every year, but also she's using that very wisely at this age, because the thing is actually she would want to have a flexibility as in when she retires at 60 years. So she can choose that flexibility and she can withdraw from these ISA pot initially for initial 5 to 10 years, so that, like, she will get the benefit. Now the third step which she does is she is also make sure that, like, she can try and withdraw from the ISA for the first 5 years, and then after she'll be jumping into the pension pot. So again, the same strategy, which is 25% allowance, which is government, like, tax-free allowance. So you can withdraw up to 25% each tax year if you're above 57 years. So she's basically combining these two together, and she's basically withdrawing from those pots, and this is how she is doing it. So by doing that strategy, we need to understand that she's basically trying to keep her income low during those years. So basically she is playing very safe and she understands how she could approach her retirement. Okay, now this comes to a very good question in my mind, that should we be on a basic rate taxpayer the time when you contribute initial years, during those initial years, and should we be on a basic rate taxpayer the time when you retire? Okay, or we should be on a basic rate taxpayer the time when you are contributing initially, those initial years, and we should be on a higher rate taxpayer the time when we retire, or we should be on a higher rate taxpayer when we start contributing, and we should be on a very low, or sorry, basic rate taxpayer at the time when we retire. So there could be different situations here. Now the thing is actually, in the ideal scenario, if you are a higher rate taxpayer or an even additional rate taxpayer, it's better to have the government bonus at first initial years. So initially, if you're on higher rate taxpayers, that would be a very good bonus for you, because you'll be getting that money on top of that, the government bonus. Also, we should not forget the fact that we could claim back our additional contribution from the government as well by doing a simple process called a self-assessment return. Okay, and that is a very easy process through your government portal. Okay, so that we should do that. But the time when we retire, we should be on a basic rate taxpayer, because the thing is actually the tax implications will be very higher the time when you retire. So we need to make sure that this is just like the open thing which I'm just sharing with you. So, like, it could be different from person to person, because there could be many different cases. But in ideal scenario could be you should be on a basic rate taxpayer the time when you retire, so you'll have less burden on the taxes. So that's how, my dear friend, you can combine the pensions and ISAs for the UK retirement. So you can get the best of both worlds, and that is the tax efficient long-term growth on the one side, as well as the flexible access when you might need it. Okay, so I hope this video was helpful, and I'll see you in the next video.